So in traditional assets like bonds and equities that you're talking about, where do you find the better opportunities, especially when it comes to relative pricing?
Well, for us, it's still looking at the traditional quality assets we see within the investment grade space. And that relative pricing point that you mentioned there, when we compare, say, the BAA corporate bond spread or corporate bond yield to the earnings yield in the US, that spread has really much evaporated, having been quite a large gap for some time. So it suggests the relative pricing towards corporate bonds is still quite good compared to equities. We see the quality bias coming through there at a time we still have that cautious degree or cautious attitude towards the equity markets around the world. And we're picking up a little bit of carry. Now, those spreads could widen a little bit given some of the outlook for the economy and some of that uncertainty that would come through. But we feel that risk-reward is a bit better balanced when it comes to the credit space. I would stress that is on the higher quality end. When it comes to things like high yield, we do expect to see spreads widen out a little bit more. We could see more risk around the recession being priced in there. So we would be keeping it generally towards the higher quality end of the credit space at the moment.
How will the US CPI print on Thursday play into your call?
Well, I think, as you was discussing earlier, I think there's the expectation that year-on-year print is going to come down by a few tenths of a percent across both headline and core rates. The real issue there is, how much of it's going to be driven around those services and that tightness in the labour market that's feeding through into wages and also on those shelter costs. And it's really coming back to the sort of competition between the hare and the tortoise, if you will. The hare is really the tightening of financial conditions. The tortoise is the slow movement in inflation, and really whether that inflation rate is going to come down fast enough or whether financial conditions will tighten too much in the near term. I think for us, the view is really that we will see inflation rates fall over the course of the next year in the US, but the path of that is still to be determined and the final rate is still to be determined as well. And again, that's going to add to that uncertainty and maybe a little bit of that volatility we've seen in the equity market this year and the response from the Federal Reserve to it. So again, a reason for us to be a little bit cautious on equities at the moment, given that it's going to be quite a large overhang for a couple of months.